Have you ever wondered why almost every trader in the world looks at candlestick charts before making a trading decision? Whether it's stocks, Forex, crypto, or commodities, candlestick charts have become the universal language of financial markets. But what's fascinating is that this powerful tool wasn't created by Wall Street or modern computers. Its story began more than 250 years ago in Japan. The history of candlestick charts takes us back to the 18th century during Japan's Edo period. At that time, rice was one of the country's most valuable commodities. Rice wasn't just food, it was a form of wealth, and traders bought and sold rice in organized markets. Among these traders was a man named Munehisa Homma, a wealthy rice merchant from Sakata, Japan. Homma wasn't an ordinary trader. He believed that market prices were driven not only by supply and demand, but also by human emotions such as fear, greed, hope, and panic. While other merchants focused only on the quantity of rice available, Homma carefully studied how people reacted to changing prices. He noticed that the psychology of traders often repeated itself, creating recognizable patterns in the market. To record these price movements, Homma developed a unique visual method. Instead of writing only numbers, he represented each trading session with a shape that clearly showed four important prices: the opening price, the highest price, the lowest price, and the closing price. If the closing price was higher than the opening price, it suggested buyers were stronger. If the closing price was lower, it indicated sellers had taken control. This simple yet brilliant idea allowed traders to understand market sentiment at a glance. According to historical accounts, Homma became one of the most successful traders of his time. Some stories even claim he achieved hundreds of consecutive winning trades, although the exact numbers remain debated. Regardless of the legends, his influence on trading psychology and price analysis is undeniable. For many decades, candlestick charts remained largely unknown outside Japan. Western traders mainly relied on line charts and later bar charts. While these methods displayed price information, they didn't communicate market emotion as clearly as candlesticks did. Everything changed in the late 20th century. During the 1980s, an American technical analyst named Steve Nison discovered Japanese candlestick techniques while researching financial markets. He realized that these charts provided a much clearer picture of buyer and seller behavior than traditional charting methods. Fascinated by their effectiveness, Nison studied the Japanese techniques in depth and introduced them to the Western financial world. His books and seminars sparked enormous interest among traders. Soon, professional investors, institutions, and retail traders began adopting candlestick charts. As computer-based trading platforms became more common in the 1990s and early 2000s, candlestick charts quickly became the default chart type on nearly every trading platform around the world. Today, candlestick charts are used in virtually every financial market. Whether you're trading Apple shares, Bitcoin, gold, crude oil, or the euro against the US dollar, the same candlestick principles apply. Every candle tells a story about the battle between buyers and sellers during a specific period of time. Over the years, traders have also identified numerous candlestick patterns that may provide clues about potential market movements. Patterns like the doji, hammer, shooting star, bullish engulfing, and bearish engulfing, now recognized globally. However, experienced traders understand that these patterns should never be used in isolation. They become more meaningful when combined with trend analysis, support and resistance levels, volume, and proper risk management. One of the biggest reasons candlestick charts have survived for centuries is that human psychology hasn't changed. Markets may now move with algorithms, artificial intelligence, and high-speed computers, but fear and greed continue to influence financial decisions. As long as human emotions remain part of the market, the principles behind candlestick charts are likely to remain relevant. From the rice markets of 18th century Japan to today's global financial exchanges worth trillions of dollars, candlestick charts have traveled an extraordinary journey. What began as a simple method to understand rice prices has evolved into one of the most trusted tools in technical analysis. More than 2 centuries later, traders around the world still rely on this timeless invention to read market sentiment, identify opportunities, and make better trading decisions.